My name is Margaret Louis, the Chief Executive Officer of Azalea Investment Management, the manager of Astrea IV. Let me first thank you for taking the time to view this presentation on Astrea IV. Please take a moment to review the legal disclaimer on slide 1 and 2.
The following video contains information about the Astrea IV Class A1 public offer, which is an offer only to investors in Singapore. The prospectus in respect of the offering by Astrea IV Public Limited of the Class A1 bonds in Singapore is available for collection at selected DBS or POSB branches during operating hours until 12 p.m. on 12 June 2018. Anyone wishing to acquire the Class A1 bonds will need to make an application in the manner set out in the prospectus.
I will kick off the presentation by providing a summary of the transaction. I will provide you with an introduction to the Azalea Group and the manager of Astrea IV. After that, a private equity primer and the fourth transaction will be covered. Astrea IV is an offering of 3 classes of bonds amounting to $501 million. All bonds are expected to be rated investment grade on the Singapore Exchange. The bonds are backed by cash flows from a quality portfolio of private equity funds of $1.1 billion. The key credit strengths of the transaction are the diversified portfolio of private equity funds backing the bonds, the over-collateralisation with a loan-to-value of 45.6%. And there are structural safeguards in place. This slide provides an overview of the 3 tranches of bonds in the Astrea IV transaction. Starting from the senior tranche, the Class A1 bonds will be denominated in Singapore dollars. The interest rate is 4.35% per annum. Half of Class A1 bonds will be available to retail investors. The other half has been placed to institutional and accredited investors. The interest rate was determined based on their demand. Class A2 and Class B bonds were placed out to institutional and accredited investors. Before going into the Astrea IV details, let me first provide an introduction to the Azalea Group, which is the sponsor and manager of Astrea IV. Azalea is indirectly wholly owned by Temasek Holdings, with an independent board and management. The management arm of the Azalea Group is Azalea Investment Management, which is also the manager of Astrea IV. Azalea has a deep bench of experience in private equity. We have successfully launched Astrea III in June 2016, which was a significant milestone towards making private equity more accessible to the wider investment community. Azalea is in the business of investing in private equity. We are focused on the development and innovation of new investment platforms and products to bring private assets to a wider investor base, starting with private equity. By wider investor base, we mean the retail public. Our mission is to continue to develop and innovate the Astrea Platform to broaden access in a phased approach to private equity-based products. To this end, we are committed to investor education. This vision to broaden access to private equity started in 2006, when Temasek initiated the Astrea Platform with Astrea I, which was a securitization of 46 quality PE funds. By securitization, we mean we put together the funds in an asset-backed security format. At the time in Astrea I, 2 classes of rated securities and 2 classes of unrated securities were issued to institutional investors globally. The 2 classes of rated securities were rated by S&P and Moody's. Despite the global financial crisis in 2008 and 2009, the Astrea I bonds maintained their credit ratings throughout their tenure. The interest was duly paid, and the principal were paid in 5 years. Astrea II was a sale of interest of an entity which held a well-diversified portfolio of 36 quality PE funds. And in Astrea III, it was an issue of $510 million of 4 tranches of bonds backed by $1.1 billion of private equity funds. These bonds were offered to institutional and accredited investors. Astrea III was the first listed bond in Singapore based on private equity. The Astrea III bonds has done well so far. For more details, please visit the Astrea III website. And Astrea IV will be the first listed retail PE bond in Singapore. This is indeed a significant step towards achieving Azalea's vision of connecting retail investors to private equity. This slide introduces the Astrea IV board members. The board has a balance of skill sets, including veterans with rich experience in private equity and in the capital markets. The gentleman on the top left is Dr. Tay Kok Peng, the chairman of Astrea IV Board. He was the former president of GIC Special Investments, which includes private equity fund investments of GIC. This slide shows Azalea's senior management. The team has broad experience in the private equity industry and successfully developed the first listed PE bond on SGX in Astrea III in 2016. A little introduction about myself. I spent most of my career in Temasek in various investment and corporate restructuring roles. My last appointment at Temasek was Senior Managing Director. I joined Azalea at its inception in 2015 and successfully led the team to launch Astrea III in 2016. Before we dive into the Astrea IV transaction, I would like to spend some time on private equity, which is the underlying asset class of the transaction. This will provide some background on the rationale for the Astrea IV portfolio. As shown in the table above, performance of private equity as an asset class has outperformed the public markets over the long term. The private equity market has grown significantly since 2000, growing at an annualized rate of 11.3% to reach $4 trillion in 2017. So what is private equity? Private equity in general refers to investments in private companies or publicly traded companies that were acquired and then privatized at a later stage. Majority of these private equity investments are made by private equity funds. Private equity managers seek to make operational and financial improvements to the companies they invest in. Ultimately, the goal is about making profits when they sell off these investments after making the improvements. Here you can see some brands which you may be familiar with that are or were owned by private equity. PE funds employ a variety of strategies, and as shown in the chart, the buyout and growth equity strategies have produced consistent median returns of 14% and 12% respectively. We like these strategies, and the Astrea IV portfolio is strategically weighted to these strategies. The characteristic of private equity is the J curve. Now, let me explain what the J curve is. Private equity funds typically have a fund life of 12 to 13 years. In the initial 4 to 5 years of the fund life, investors experience net cash outflows due to drawdowns to fund investments and fees. Investors receive net cash inflow only in the later years when the investments mature and are sold away. The effect is also known as the private equity J curve. As shown in the graph, PE funds in the shaded area are more mature and cash flow generative. Astrea IV portfolio has a weighted average fund life of 7 years and is therefore considered to be mature and cash flow generative. Here we show the risk of capital loss of a single PE fund and a secondary fund of funds. As shown in the chart below, fund of funds have demonstrated superior downside protection compared to a single PE fund. A secondary fund of funds acquire interests which are in the mature stage through secondary market purchases. Investing in a portfolio of secondary fund of funds has competitive risk-adjusted returns with lower risk of capital loss. Based on funds' historical performance from Preqin, which is a well-respected provider of private equity data, only 1.6% of secondary fund of funds experience a capital loss. So similar to a typical secondary fund of funds, the Astrea IV platform is diversified, mature, and cash generative. Investors in private equity are mainly large institutional investors, like pension funds, and to a much smaller extent, high net worth individuals. This is due to the relatively high barriers to entry that make it difficult for retail investors to invest. Firstly, the minimum investment capital required is usually from $1 million. Secondly, PE investments have long holding periods. That is why PE is highly illiquid and more suitable for large institutions which have very long-term investment horizons. Thirdly, PE investors must be comfortable with the J-curve effect as explained previously. However, our PE bonds can be the key to unlocking these high barriers. Let me show you how. Firstly, PE bonds allow for smaller investment lots, which means investors do not have to put in large amounts of capital in order to invest. The minimum subscription for Astrea IV Class A1 bond is 2,000 Singapore dollars. Secondly, investors' capital is only tied up for the duration of the bond's tenure. The Class A1 bond has maturity of around 5 years, much shorter than the 10-year period that PE investors expect their capital to be tied up for. Thirdly, a seasoned and diversified underlying portfolio is cash generative and bypasses the initial negative cash flow phase of the J curve. Of course, these are bonds, and these are not equity in the PE portfolio. However, this is a first step to our gradual approach to bring PE exposure to retail investors and help private equity to slowly become a part of retail investors' portfolio. Next, I would like our colleague, Mr. Chu En Yao, Managing Director, and Head of Private Equity Funds, to present the overview of the Astrea IV transaction.
Thank you, Margaret. I'll now run through the Astrea IV transaction. Astrea IV is the first listed private equity bond. The bonds are backed by cash flows from 36 private equity funds. The Class A1 bonds are offered to retail investors and will be listed on the main board of the Singapore Exchange. There will be 121 million Sing dollars of Class A1 bonds for the public offer. The bonds will pay an annual interest rate of 4.35% per annum, and the interest will be paid to bondholders every 6 months. It has a non-call period of 5 years, and the earliest date to repay the principal back to the bondholders will be 14th of June 2023. In the event that the bonds are not repaid at the end of the 5th year, there will be a 1% one-time step-up in interest rate to 5.35% until the bonds are fully repaid. There is also a bonus of 0.5% of the principal of Class A1 should the underlying portfolio performs and meet the performance threshold. This slide highlights the key parties involved and a summary of their roles. The sponsor initiated the Astrea IV transaction. The issuer is Astrea IV Private Limited and is a special purpose vehicle incorporated in Singapore. The two asset owning companies are Astrea IV Assets I and Astrea IV Assets II. Together, they hold the 36 private equity funds. On the left-hand side, the manager is Azalea Investment Management, a wholly owned subsidiary of Azalea Asset Management. Sun Singapore, an independent and established transaction and fund administrator, will take care of the middle office functions, such as accounting and administering the transaction, and will be supervised by the manager. The other counterparties in this transaction includes the credit facilities provider, DBS Bank. In the event of any cash flow shortfall, they will provide cash to cover operating expenses and the funding of capital costs from the underlying funds. The remaining counterparties include the hedge counterparties, as well as the bond and security trustees. As the underlying cash flows are mainly in US dollar and the Class A1 is denominated in Sing dollar, we have hedged out the forex exposure from day one. We have also hedged part of the European assets held. The entire dotted box is also known as the asset-backed security structure. This slide shows the offering of Class A1, which is the most senior class of bond. Class A1 bond is denominated in Singapore dollars and have a placement tranche of 121 million and a public tranche of 121 million. The placement tranche is completed with institutional and accredited investors, and they help to set a competitive interest rate through a book building process. The Class A1 bonds is expected to be given an A rating by both Standard & Poor's and Fitch. Class A bonds have a 5-year non-call period with a straight line reserve of principal amount over this period. As mentioned in the earlier slide, if the Class A bonds are not redeemed on year 5, there will be a 1% step up in interest rate. However, if the portfolio performs well and meet the performance threshold, there will be an additional bonus of 0.5% of the principal at the point of repayment. This slide shows a simplified illustration of the priority of payment, or what is commonly known as the waterfall. As the name waterfall implies, the way in which the cash can be used by the issuer have already been predetermined from day one. There is no discretion on how the cash can be used otherwise. The cash that is generated by the 36 underlying funds and received by the issuer will be paid out every 6 months in the following order. The cash will first be used to pay for senior operating expenses such as taxes and expenses, management fees, and liquidity facility fees. Clauses 1 to 4 help ensure the structure can operate smoothly. The cash is then used to pay interest for bondholders in clauses 5 and 6. The following next few clauses are designed to protect bondholders. Clause 7 helps ensure that should the issuer decided to sell some of the underlying funds, all the disposal proceeds will go to the reserve accounts of Class A. Clause 8 ensures that up to $40 million in US dollar of cash is set aside every 6 months into a reserve account that can be used to repay Class A bondholders in full at the end of 5 years. There is also a catch-up mechanism to ensure that if insufficient cash is set aside in the current period, it will be topped up in the next period. After making sure that the interests of the bondholders are taken care of, the sponsor can then receive the residual cash. However, before the cash can flow to the sponsor, Clause 10 ensures that there must be sufficient assets remaining through a maximum loan-to-value test. If the loan-to-value exceeds 50%, the residual cash will then be diverted into the reserve account to reduce the debt level. If the LTV test passes, the cash can then be used to pay for junior expenses in clauses 11 to 13. Clause 14 is the payment to the sponsor. As you can see from the waterfall, the sponsor can only receive cash after making sure that the operating needs of the structure and the interests of bondholders are taken care of. This slide summarizes the key credit strengths of this transaction. Firstly, a diversified and mature portfolio. Secondly, a well over-collateralized structure. Thirdly, structural safeguards in place to protect bondholders. Astrea IV has a quality portfolio of 36 private equity funds that is well diversified geographically with 63% in US, 19% in Europe, and 18% in Asia. The reason why it is concentrated in US is because the US is the most developed private equity market. The private equity market in Europe and Asia are fast growing and help provide diversification. The portfolio is strategically weighted towards buyout and growth strategies, and the top 3 funds are Blackstone 6, PAG Asia 1, and Silver Lake 4. As discussed earlier, the buyout and growth strategies generated the highest median return of 14% and 12% respectively historically. The funds are well diversified across vintages from 2006 to 2014. This is important as the older and more mature funds help ensure cash flow visibility from the portfolio in the near term, and the younger funds help to provide cash flows in the later years. In addition, the value of the younger funds could potentially increase in value as the underlying companies grow and mature over time. The potential increase in value will help to protect the bondholders further. The weighted average age of the portfolio is 7 years. And as we have shown you in the J-curve earlier, a portfolio of PE funds that are mature are highly cash flow generative. In contrast to a corporate bond, where bondholders rely on the performance of one company, the Astrea IV PE bond is backed by cash flows from 596 underlying companies. The largest company in this portfolio is at about 2.6% of the NAV, showing you that it is very well diversified. The companies are diversified across sectors ranging from IT, consumer, industrials to healthcare. This slide shows you the Astrea IV funding structure. Including Class A2 and Class B bonds, the total bonds issued is $501 million. The portfolio is valued at $1.1 billion. The loan to value is 45.6%. In other words, the bonds are backed by a portfolio that is worth more than twice its value. The entire equity is held by the sponsor. This shows a strong alignment of interest to ensure that the portfolio performs. In this regard, the sponsor has incorporated features to benefit Class A1 bondholders through the sponsor sharing. As discussed in earlier slides, the sponsor is entitled to receive cash under Clause 14 of the waterfall. In the event that the portfolio performs well and the sponsor receives half of its total equity, or approximately $330 million before year 5, it will mean that the performance threshold is met. When the performance threshold is met, two things will happen. One, the sponsor will share from its proceeds 0.5% of the principal of Class A1 as bonus to the Class A1 bondholders. Two, from that point onwards, the sponsor will accelerate the reserves by sharing 50% of its cash flow entitlement under Clause 14. This means that there is a chance that the Class A bonds will be fully reserved before the end of year 5. Astrea IV has several structural safeguards in place to protect bondholders. Let me do a quick summary here. First, the reserve mechanism. Every 6 months, cash of up to $40 million will be set aside for the final repayment of both Class A1 and Class A2 bondholders. At the repayment date, the reserve that was set aside will be used to first repay Class A1 bondholders, followed by Class A2 bondholders. Second, the sponsor sharing will allow Class A1 bondholders to enjoy a small bonus and accelerate the cash that is set aside in the reserve account. Third, the maximum LTV ratio test will maintain the loan to value at below 50%. If the loan to value exceeds 50%, cash will be diverted into the reserves account. Lastly, a liquidity facility is available to cover senior expenses and bond interest payments in the event of cash flow shortfalls. This facility allows the issuer to operate for 3 years without any distributions from the underlying funds, and also ensure that Class A bondholders will receive their bond interest every 6 months. A capital call facility is also available to cover capital calls from the underlying PE fund investments in the event of cash flow shortfalls. The key investment risks are as follows. The ability of the issuer to repay the bondholders is highly dependent on the performance of the underlying funds. A rising interest rate environment may cause the price of the bonds to fall in the secondary market. While the bonds are secured against the assets of the issuer and the sponsor, they are not guaranteed. And if you decide to sell the bonds before the scheduled call date, there may be a limited trading market for these bonds. To conclude, the key takeaway of Astrea IV PE bonds is as follows. The bonds are backed by cash flows from a quality portfolio of PE funds. The portfolio is mature and cash flow generative and diversified across 596 companies. The bonds are also rated A by both S&P and Fitch. Class A1 bonds have an interest rate of 4.35% per year, and the interests are paid out every 6 months. With this, we have come to the end of the presentation, and thank you for your attention.